Hello everyone, this is the answers to your Unit 7 exercises. In Exercise 1 we have Nitro Tire Company, and we're going to track their transactions related to their inventory item Model 22A Performance Tire. During the period, they started with some tires in inventory, they purchased some tires, and they sold some tires. What we're going to do is we're going to take this information and record a perpetual inventory record, first using the LIFO method and then the FIFO method. Let's start with the LIFO method. So our method is LIFO. The item number is 22A, and they are performance tires. Our information tells us that Nitro is beginning the period with 16 tires in beginning inventory, and they were purchased at $65 a piece. So in beginning inventory, we're going to start with 16 tires in our inventory on hand. The unit cost of these tires is $65 a piece, meaning the total cost that we paid to acquire these tires in the first place was $1,040. On March 11th, we're going to purchase an additional 10 tires, and these tires are going to cost Nitro Tire Company $78 a piece. So let's take these 10 tires that we're buying and record it under the quantity column in the purchases section. We're purchasing them at a unit cost of $78 a piece, which means this purchase is going to cost us $780 in total. Because we are using the LIFO method, we can't just merge our inventory. Yes, we had 16 and we're buying 10 more, so we'll have 26 tires, but we can't just say we have a quantity of 26, because we have to keep inventory with different unit costs separated. So what we're going to do is we're going to layer our inventory. First, by bringing down our beginning inventory on hand, we had 16 $65 tires with a total cost of $1,040, and we just purchased 10 tires at $78 a piece for $780. We're going to make that our separate, distinct layer of inventory. So yes, we have 26 tires, but those 26 tires, 16 of them cost us $65 and 10 of them cost us $78. On March 23rd, we're going to sell 12 of these tires. Well, we're using the LIFO method, and that means that we are selling the last tires that we purchased first, or at least we are assuming that we are, because we can't distinguish which tire is which just by looking at it. So what is the last inventory that we purchased? It was the March 11th purchase, and those units cost $78 a piece. So to get to those 12 tires that we're selling, we're going to assume that we're selling all of our newest inventory first before we dig into what we had in beginning inventory. So let's sell all 10 of those $78 tires and have a total cost of goods sold from those 10 tires of $780. But we didn't just sell 10, we sold 12. So we also need to sell 2 tires from our beginning inventory, which had a unit cost of $65 a piece, or a total cost of $130, bringing our total cost of goods sold from this transaction to $910. What do we have left? Well, we had 10 $78 tires and we sold them all. We had 16 $65 tires and we sold 2 of them, which means we are going to have remaining in our inventory on hand after this March 23rd sale 14 $65 tires in inventory with a total cost basis of $910. On March 26th, we're going to purchase an additional 14 tires. So let's record this under the purchases section. We're purchasing 14 tires. Those tires have a unit cost of $80 a piece, which means we're spending $1,120 to acquire those tires. Again, since we're using the LIFO, we have to layer our inventory. Let's bring down what we had. We had 14 $65 tires for a total cost of $910, and then add a new layer for our purchase. We purchased 14 tires at $80 a piece for $1,120. Then on March 29th, we're going to sell 18 tires. Again, it's LIFO, so we assume we sell the last units we purchased first. Well, what is the newest inventory that we have? It's the tires that we bought on March 26th that cost us $80 a tire. Let's assume that we're going to sell as many of those as we possibly can in order to get up to the total quantity of our sale, which is 18 in this case, which will require us to sell all 14 of those $80 tires for a total cost of $1,120. And to get to the 18 units that were sold in total, we're also going to have to sell 4 of our $65 tires from beginning inventory and to get to that 18. So that has a cost of $260. What's left afterwards? Well, we're going to have 10 $65 tires left. So our total cost of inventory on hand for our Model 22A performance tires after the March 29th sale is going to be $650. Then we need to figure out our totals. So total quantity purchased is easy enough. On March 11th, we purchased 10 units. On March 26th, we purchased an additional 14 units. In total, during the month, we purchased 24 units. The cost of the March 11th purchase was $780. We spent $1,120 on the March 26th purchase. Well, if we add that up, we get $1,900. So we bought 24 tires during the period, and we spent a total of $1,900 acquiring those tires. The quantity of tires sold is just equal to the sum of the quantity column in our sales or cost of goods sold section. We sold 30 tires, and the total cost of goods sold that we recognized on those tires is equal to the sum of this column, which is going to come out to be $2,290. For our inventory on hand, it is whatever is remaining in your inventory after your last transaction of the month. What did we have left after our last transaction, which was the March 29th sale? We had 10 tires with a total cost of $650. Let's do the same thing this time using the FIFO method. So our FIFO perpetual inventory record for our item 22A tires is going to start the same way the LIFO one did. Our beginning inventory is going to be the 16 $65 tires for a total cost of $1040. Our first transaction is still going to be on March 11th when we purchased 10 tires. It's $78 a piece for a total cost of $780. And just like we did under LIFO, we have to layer our inventory. So let's bring down what we had. We had 16 $65 tires and add a new layer for our new units purchased. The 10 tires with a unit cost of $78 a piece for a total cost of $780. Next up, on March 23rd, we had a sale of 12 tires where we're using FIFO now. And that means the first tire that we have in inventory that we purchase is going to be assumed to be sold every time we make a sale. In other words, we're always selling our oldest inventory first. Well, what's our oldest inventory? It's what we had in beginning inventory. So when we sell those 12 tires, we're going to assume that they all came from beginning inventory, which had a unit cost of $65 a piece. So our total cost of goods sold on our March 23rd sale is going to be $780. What's left? Well, we had 16 tires in beginning inventory, from beginning inventory, with a cost of $65 a piece. We sold 12 of them, so we have 4 of those $65 tires left for a total cost of $260. And we still have all 10 of the $78 tires for a total cost of $780. On March 26th, we're going to purchase an additional 14 tires. These tires have a unit cost of $80 a piece, so our total cost of our March 26th purchase is going to be $1,120. We have a purchase with a different unit cost than our previous inventory, which means we need to create a new layer. So let's bring down what we had. We had 4 $65 tires for a total cost of $260. We have 10 $78 tires for a total cost of $780. And now we have our new layer for our new inventory. 14 tires, $80 a piece, total cost of $1,120. So we're standing here now with 28 tires in total in inventory, but they're contained in 3 separate layers. Our last transaction of the month is on March 29th. We're going to sell 18 tires. Well, we're going to assume that our oldest inventory is being sold first, and our oldest inventory are those 4 tires from beginning inventory with a unit cost of $65 a piece for a total cost of $260. We need to get to 18 tires in total, so that means we can also sell all 10 of these $78 tires that we purchased on March 11th. The total cost of that would be $780. And then we got to get to 18. That's only accounting for 14 units sold, so we're also going to have to sell 4 of our $80 units for a total cost of $320. So we sold 18 tires, but we sold those 18 tires from 3 different layers of inventory, meaning we have 3 different unit costs. All that we're going to have left at the end of the period then, since we sold all of our $65 units and all of our $78 units, is the 10 $80 units with a total cost of $800. And again, to compute our totals, we just add up the quantity column under the purchases section and realize we purchased 24 tires. We paid in total $1,900 for those tires. our sales, well, we still sold 30 tires in total. Using the FIFO method, we're going to have a total cost of goods sold on those sales of $2,140. And then for inventory on hand, we bring down what we had left after our last transaction of the month. We had 10 tires, and those 10 tires cost $800. So let's assume that this company, Nitro Tire Company, generated $2,640 worth of sales revenue from a particular tire during the period. Let's figure out the gross profit they're going to record under both the LIFO and the FIFO method. Well, revenues don't change based upon your inventory methodology. I don't care what one you use, it's always going to be exactly the same. In our case, $2,640. To get to gross profit, we need to subtract our COGS from our revenue. Well, our gross profit under the LIFO method was $2,290. And under the FIFO method, it was $2,140, taken right from the total column on the bottom of our perpetual inventory record, which means if this company is going to use LIFO, they're going to recognize a gross profit of $350. But if they use FIFO, they're going to recognize a gross profit of $450. So what are some of the benefits and disadvantages of the two methods? Well, for the LIFO method, you're always going to have the highest cost of goods sold, which seems like it would be a bad thing. But when you have the highest cost of goods sold, which is an expense, you're going to have the lowest amount of income. And when you have the lowest amount of income, you pay the lowest amount of taxes. So companies tend to gravitate towards the LIFO method because it reduces the taxes that they have to pay. Yes, it does result in you carrying lower ending inventory because you're always selling your highest units first, highest price units first, and carrying that older inventory on there, but it reduces your tax liability. And that's not such a popular thing in the world. So pretty much everywhere except for the United States, LIFO has been outlawed. It is completely forbidden under IFRS. They can't use the LIFO method to value inventory in Europe or in Asia or in any of these other places that use IFRS. The FIFO method gives you the lowest cost of goods sold because you're selling your older and assumed to be cheaper inventory first, which means you're going to report a higher income. But since you're reporting a higher income, you're paying more taxes. The offset of this is you also carry the highest amount of inventory because since you're always getting rid of your old, cheaper inventory first, the inventory you're assuming that you still have on your books is the more expensive, newer inventory that you just purchased. This is permitted under IFRS, and FIFO is much more common in the rest of the world than it is in the United States of America. Moving on to exercise 2, we're going to use another methodology, which is the moving average or weighted average, or AVCO if you will, method of valuing inventory, and we're going to do it for Guitar Central and one of their inventory items, which is 103A, the Sunburst Les Paul standard guitar. Again, we have their quantity of beginning inventory and a list of all of their purchases and sales related to this inventory item. But we can track this using an inventory record. So our method this time is the weighted average method, which I like to abbreviate to AVCO. This is for our item number 103A Les Paul guitar. The first thing it says is that Guitar Central did not have any model 103A Les Pauls in inventory at the beginning of the period. So our beginning inventory is just 0. Simple enough. The first transaction we have is on January 1st. Guitar Central is going to purchase 15 of these guitars for $1,200 a piece. So let's throw that in the purchases section. 15 guitars at a unit cost of $1,200 means the total cost of our purchase is going to be $18,000. And since we didn't have any inventory on hand to start the period, it's also going to be our inventory on hand afterwards. We have, after this purchase, we have 15 guitars. Each one of them costs us $1,200 a piece. So the total cost of inventory that we're reporting on our books as of January 1st is going to be $18,000 for this model 103A Les Paul guitar. During January, we sold 7 of these, and the sales price was $2,100 per guitar. You can track your sales at the end of the month for each item. Instead of every time we sold a guitar, we're just going to wait till the end of January and put them all on the books at once. So on January 31st, we are selling 7 guitars. And I know the sales price was $2,100 per guitar, but the sales section on our inventory record records not our sales cost price, but our unit cost that we paid to acquire the guitars. What I'm saying is, under the AVCO method, whenever we make a sale, we're always assuming that we are selling at the last known unit cost of our inventory on hand, which in this case was $1,200. So the cost of goods sold we would recognize on January sales is $8,400. We had 15 of these guitars, we sold 7, which means we have 8 left. The unit cost does not change on a sale under the AVCO method. So those 8 guitars that we have in our ending inventory still had a unit cost of $1,200 a piece, which means that the total cost of inventory on hand at the end of January is going to be $9,600. Next up, on February 15th, we are going to purchase an additional 8 Les Pauls. This time we're going to pay $1,300 per guitar. So we're buying 8 guitars at a unit cost of $1,300, which means this purchase is going to cost us $10,400. Well, now our inventory on hand is going to change. We had 8 of these guitars, we bought 8 more, we have 16 in total. We need to change our unit cost. Before we can get to the unit cost, we have to figure out what our change is to our total cost. Our inventory before this purchase was $9,600 in total cost. We just spent an additional $10,400 acquiring these 8 more Les Pauls, which means the 16 Les Pauls that we're going to have in inventory after this February 15th purchase would have had a total cost of $20,000. So what is our cost? Well, it's the AVCO method. So it's the average cost of all of the guitars we have in inventory. Well, how do we figure that out? Simple enough. We take our total cost after the purchase, which is $20,000. We take our total quantity that we're going to have after the purchase, which was 16, and we're going to divide total cost by total quantity to determine that the average cost of our Les Paul guitars at this point was $1,250 a piece. And on February 28th, when we recognize February's sales, we're going to need that information because we sold 12 guitars during February, so our quantity of sales was 12. Again, under AVCO, we're going to assume that we're selling all of these at the last known unit cost. Well, that was $1,250, which means that our total cost of sales, or our cost of goods sold for February sales, was $15,000 for these Model 103A Les Paul guitars. We had 16 of them at the beginning of the period. We sold 12 during the period, which means we have 4 left. Our unit cost does not change in the AVCO method when we make a sale, so we're going to have them at an average cost of $1,250, which means the total cost of the guitars we have on hand at the end of the period is $5,000. On March 1st, we're purchasing an additional 12 Les Paul guitars, and we're purchasing them for $1,351 a piece. So we take our 12 guitars that we were purchasing at a unit cost of $1,351 a piece. Compute that the total cost of this purchase is going to be $16,212, and we're going to use that information to figure out what the total cost, new quantity, and new unit cost is of our inventory on hand after this March 1st purchase. We had 4 guitars, we bought 12 more. Now we have 16 Model 103A Les Paul guitars. Our cost basis was $5,000 for the inventory we had before this purchase. We just spent an additional $16,212, which means that our total cost is now $21,212. And to figure out our new average cost, we take $21,212 divided by our quantity of 16. We come up with $1,325.75. I don't like pennies that much, so we're just going to report it as $1,326. On March 31st, we're making one more purchase. We're purchasing an additional 6 guitars, and we're purchasing these at $1,398 a guitar, for a total cost of $8,388. Well, let's figure out what our new inventory on hand was. We had 16, we bought 6, now we have 22 guitars. The cost of our guitars on hand before the purchase was $21,212. Well, let's add to that the $8,388 we just spent on this purchase, and we're going to come up with $29,600 that we have paid for these 22 Les Paul guitars that we have in stock in our inventory on hand. And to figure out our new average cost, We take our total cost, divide it by our new total quantity, and our average cost comes out to be $1,345.45. Let's just report it as $1,345. And now we need to figure out our totals. So our total purchases, we purchased 15 units, then 8 units, then 12 units, and then 6 more units. So in total we purchased 41 of these guitars during the period. The total cost of our purchases is $53,000 on the dot. For sales, we sold 19 guitars during the period. We have a total cost of sales of $23,400. And then for our inventory on hand, we ended the period with 22 Model 103A Les Pauls in stock, and the total cost of those was $29,600. Now we need to figure out our gross profit related to our sales. So let's check our sales first. The first sale we had was during January. We sold 7 guitars. Well, our unit sales price, if you were wondering where this information was going to come in, is $2,100, which means our revenues from January sales should be $14,700. During February, we sold 12 guitars, and we sold them at a price of $2,150 a piece, which means our revenue from February sales would have been $25,800. Well, if we add that together, we have total revenues of $40,500. And from that, we can subtract our cost of goods sold to find our gross profit. Well, our cost of goods sold, we just figured out on our perpetual inventory record, was $23,400, which means the gross profit the Guitar Central is going to recognize from sales of Model 103A Les Pauls for the quarter is going to be $17,100. One more exercise, another one for Guitar Central. This time we are selling inventory item 117B, which is a black Fender Jazz bass. We have their beginning inventory levels, all of their purchases, and all of their sales. Let's use the AVCO method to figure out what our cost of goods sold was and what our inventory on hand was at the end of the period using a perpetual inventory record. So once again, we are using the AVCO method for item 117B, which is our Fender Jazz bass. Beginning inventory, well, we did not have any black Fender Jazz basses in inventory at the beginning of the period, so that's all zero. On January 1st, Guitar Central is going to purchase 9 of these for $600 a piece, which means the total cost of that purchase was $5,400. We didn't have beginning inventory, so that is also our inventory on hand after this purchase. During January, we sold 4 of these, and we sold them at a price of $1,000 a piece. So January 31st, we sold 4, but again, the selling price is not what we're going to report. What we're going to report is our cost basis on the items that we sold, which is going to be our last known unit cost of $600, which means we're going to recognize $2,400 of cost of goods sold on this sale. And after we sell these 4 bases, we will have 5 of them left. Each base will have a unit cost of $600, which means we have $3,000 in total costs related to these bases on our books. On February 14th, we're going to purchase an additional 5 of these at a price of $630 a piece. So let's fill that information into our purchases section for a total cost of $3,150. And let's figure out our new inventory on hand. We had 5, we bought 5. Now we have 10 Fender Jazz basses in total. Our cost of the basses that we had in inventory before this purchase was $3,000. We just spent another $3,150, so we have $6,150 in costs for our Model 117B Fender Jazz basses. So to figure out our new average cost of our inventory on hand, we take our new total cost divided by our new quantity. $615 is going to be our unit cost for our Fender Jazz basses that we have on hand after this February 14th purchase. On February 27th, we're going to purchase an additional 5 Fender Jazz basses for $636 a piece, which means the total cost of that purchase is going to be $3,180, and we once again need to figure out the new levels of our inventory on hand. We had 10 of these bases, we bought 5 more, so we're up to 15. Our total cost of the bases we had before was $6,150. Well, we just spent another $3,180, which means our total cost of all 15 of these bases is $9,330. And to figure out our average cost, we take total cost, divide it by total quantity, and we get an average cost of $622 per base. Lastly, on March 1st, we're going to purchase, Next, during February, Guitar Central is going to sell 10 of these. So February 28th, we'll recognize our monthly sales. We sold 10 bases, and whenever we sell at the last known unit cost, which is $622, which means the total cost of goods sold that we get to recognize on February sales was $6,220. We had 15 of these bases. We sold 10, which means we've got 5 left. The unit cost does not change under AVCO when you make a sale, which means it's still $622, which means our assumed total cost of our inventory after we recognize February sales is going to be $3,110. Then on March 1st, we're going to make another purchase, and we're going to buy 10 bases. They cost $646 a piece, which means our total cost of this purchase is $6,460. Well, we had 5, we bought 10, now we have 15 Model 117B Fender Jazz basses in inventory. Our total cost beforehand was $3,110. We just spent another $6,460, so the total cost of acquiring these 15 basses is going to be $9,570. One more time, we need to figure out what our average cost is by taking our total cost, dividing it by our total quantity, and coming up with our average cost. Our average cost in this case is $638. So at period's end, we add up our columns. We have 29 bases that we purchased at a total cost of $18,190. We have 14 bases that we sold, and the total cost of goods sold we recognize would be $8,620. And we ended the period with 15 bases in inventory for a total cost of $9,570. So let's figure out gross profit for these particular models. On January 31st, we made a sale recognizing January sales of 4 bases, and our selling price, according to our information, was $1,000 a base, which means we would have made $4,000 in revenues. During February, we sold an additional 10 bases, and those bases were sold at a price of $1,050 a piece, which means we would have recognized revenues of $10,500. In total, we had revenues of $14,500 from these 2 months worth of sales. If we subtract out our cost of goods sold, which is calculated to be $8,620, we're going to have gross profit on sales of these Model 117B Fender Jazz basses during the period of $5,880.